Hello traders, do this and you shall make money. If you have been trading for even a short time, you've probably heard of the dual moving average crossover system. You probably even applied it and became utterly frustrated with it. At least you got more frustration than success. But what if I told you that there is a way to take those dual crossings and make them work for you almost every single time you take them? Skeptical? I don't blame you. I would be skeptical too. But stay with me, because in this video, I'll show you the exact steps to flip the script on the dual moving average crossover system. And I'll go as far as to say that if you do what I cover in this video, you shall make money. Yes, it's a bold claim, but I assure you, by the end of this video, you'll have all the tools you need to test this strategy and see for yourself. Here's what we'll cover. We'll start with a quick refresher on the dual moving average crossover system for any newcomers. Next, I'll dive into the strategic nuances where the system shines and where it falls flat, and I'll share my preferred moving average pairings for daily chart triumphs. And you'll want to stick around until the end, because that's when I'll drop the game changer, the big secret that has the potential to revolutionize how you make money using moving averages. Are you ready? Let's get started and unlock the full potential of your trades. In a previous lesson, we discussed the dual moving average crossover method, and we mentioned a combination that is popular and widely used, the 13 exponential moving average with the 21 SMA. The way it works is simple. When the 13 moving average crosses above the 21 SMA, it is considered a buy signal. Let me show you an example of that. This is a 6-hour chart of the Canadian dollar. The 13 exponential moving average crossed the 21 from below and gave a signal at around 131.70. Such a signal was strong enough as to take prices all the way to 138.39. That shows you how powerful those signals can be. Conversely, when a short-term moving average crosses below a longer-term moving average, it signals an increase in momentum to the downside. That means that prices are falling faster than they are rising, and it is considered a sell signal. Let me show you an example of that as well. Here is the weekly chart of the euro-dollar, and it shows both a buy and a sell signal. You can see a buy signal right here. It took prices all the way up, and when the moving average crosses down, it brought prices all the way down, all the way to the 95 area. When this strategy is used in larger time frames, as I'm showing you, it works wonders. The problem is when it is used in intraday charts, then we see a lot of false signals. Here you can see a buy signal followed by a sell signal, then a buy signal that goes nowhere, followed by a sell signal, then another buy signal that doesn't provide with any progress, and then a sell signal. And this type of whipsaw can be extremely damaging for our psychology. Luckily, there is a way we can filter the bad signals out. But before we do that, let's talk about another combination widely used in the industry, the 5 and 20 SMA. Obviously, a buy signal occurs when the 5-day average crosses above the 20, and a sell signal when the 5 moves below the 20. Let's take a look at these combinations. This is one of my favorite combinations to use on a daily chart, and for good reason. You can see on this chart how that combination caught a very large portion of the downtrend. The first sell signal was about 0.68, round here. And prices came down all the way to 0.56 without an opposite crossing on the moving average. You can see here, even though prices went up, the moving average did not cross above the larger moving average. Obviously, using two moving averages often delay the entries more than if we were to use a single moving average method. But as I showed you in a previous lesson, it produces fewer whipsaws when we use the double crossover system. Another combination worth mentioning is the 10 and 50 simple moving average, a favorite of many long-term traders. As usual, when the 10 crosses above the 50, it signals an uptrend. A downtrend is when the 10 crosses below the 50. You can see on this chart how this combination cut a large portion of the decline from 114 all the way down to 76.25. And the 50 SMA worked as resistance every time prices attempted to go higher. Now, as I mentioned before, if you use the double crossover method with the 13 and 21, the daily 5 and 20 combination, or the 10 and 50 we just discussed, there is a way to truly make them extremely reliable and practical and filter out all the whipsaws. But patience is required. It is indeed one of the most reliable ways to use the double crossover method. I am referring to the dead cross and the golden cross. A dead cross is a bearish signal that only takes place when the longer moving average is already turning down by the time that the shorter moving average crosses it. That produces a dead cross, a sell signal that is extremely reliable. A golden cross only exists when the longer moving average is already turning up when the shorter moving average crosses it. This giving a golden cross a buy signal that is extremely reliable. For example, here is the daily chart of euro using the 10 and 50 combination. You can see how the first cross was not a dead cross because the 50 right here was still flat, maybe even pointing up. But the next cross had the 50 already steeply pointing down, and that made it deadly. The signal cut a large portion of the downtrend back from January all the way here to September. The dead cross is the type of signals you want to look for and take every single time you spot it. And here you can see an example of the golden cross in the dollar yen. In this example, you can also see why it is not recommendable to take double cross signals when the slow moving average is pointing in the opposite direction of the signal, such as in this particular case. You can see how the shorter moving average crossed below it, but the longer moving average was still pointing up. That is not a signal that you want to take. The ideal signal is precisely when the longer term moving average is already pointing up by the time that this shorter term moving average crosses it to the upside. That is the golden cross. You remember how that wonderful signal in the Canadian dollar I showed you in the beginning? Well, it was also a golden cross between the 13 and the 21 averages. And that goes to show you two things. The golden and dead crosses apply to all moving average combinations, and they work on all time frame. As you can see, this one is in a 6-hour chart. The other ones I showed you were on daily or weekly charts. And this brings us to a summary of the general rules for using the double cross combination. You want to take all the golden and dead cross signals. Those are your signals to take, always without hesitation. 2. You can take all the double crosses as long as the slow moving average is flat
and not pointing in the opposite direction. And 3. Never ever take double crosses when the slow moving average is pointing in the opposite direction, as you can see in the example of the yen. You can see that the slow moving average crosses down the larger moving average and produces a sort of an X. That X should remind you, never ever take double crosses when the slow moving average is pointing in the opposite direction, as you can see right here. You can see this cross here went nowhere. In fact, as soon as it occurred, prices went against it. And even though they try to go back down, at the end of the day, they continue moving higher in the direction of the main trend as pointed by the larger term moving average, in this case, the 50.